CPI data came in at 2.9% today, year over year. That is below the 3% expectations. Check out this post from Charlie Balelo on X this morning. Notice transportation still up over 8%. Shelter still up over 5%. Electricity still up almost 5%. But on the other end of the spectrum, used cars down 10.9%. Gasoline down 2%. New cars down 1%. Gentlemen, what do you make of the inflation data? Adam, I'll start with you.
Yeah, look, I think I'm glad you kind of broke it down into some components, because I think the real key to this is how is it impacting kind of the average U.S. consumer. And with food at, what was it, 1-ish% and fuel down, I think those are the two key things from the perspective of what the day-to-day life of a consumer, which is going to make them feel better, which is going to impact their expectations of inflation going forward, which can have a positive impact on the economy. But overall, the good thing here is that it wasn't a bad print, that it didn't miss, because the market is all bulled up, pun intended, on a rate cuts coming. And now the risk is, what if the rate cuts, it doesn't come or isn't as much as people want, or doesn't happen as fast as people want? And not just this first potential cut in September, but sort of the cadence over the next few months. We've now set ourselves up that if the Fed doesn't deliver on what the market thinks, we'll have increased volatility and perhaps another sell-off. And let's not forget that a week ago, the sky was falling down. The market was 8-10% fall in 3 or 4 trading days, and we've clawed all of that back, and now everything's rosy again. People that were about to jump off a ledge are now, booking vacation homes for the end of August because they're rich again.
Well, we'll definitely dive into the volatility of last week. Austin, what are your thoughts on the CPI print?
I think it's interesting, and it's interesting how it was broken down by Charlie, because when you look at the actual data, some of the stickiest inflation is in areas of the economy or in products that people need for day-to-day life. When you look at some of the capital goods like used cars and new cars being down the most, that's definitely being driven by interest rates. But when you think about electricity and food and dining out and shelter and those things that are continuing to remain relatively sticky, you wonder if rate reductions from the Fed might cause additional problems in the economy that don't necessarily show up from the top-down data. So I think it does create somewhat of a conundrum for the Fed, as the market was demanding a 50 basis point cut last week. It does seem like that 50 basis points would be irrational at this stage, because you might be pushing up the prices on some of the day-to-day necessities more than everything else, even if it doesn't show up in the broad data.
I also think this creates somewhat of a paradox. If the Fed does come out and start lowering interest rates, that presents the potential problem of future inflation. It's spiking back up. As portfolio managers, how do you address this? Adam, I'll start with you.
Well, look, I think it depends. I think it's premature to sort of speculate on what could happen. And I think the real question is how fast does the Fed cut? How careful are they? And remember, on the upside, it was one of the fastest tightening cycles in history. That doesn't necessarily mean it's going to be one of the fastest loosening cycles in history. So, look, there's always a risk that macro data can change, and cutting rates leading to future inflation, I think, is, inflation is always a macro risk that one should think about. But I don't think because you're in a loosening cycle, you need to lose sleep over future inflation.
Austin?
I think from a portfolio's perspective, the best hedge against inflation is high quality equities that have pricing power. Another great hedge against inflation is commodities exposure. You have to be a little bit more cautious on that commodities exposure in a shrinking economy. However, when we think about putting portfolios together, we're thinking more about being in those high quality equities at reasonable prices, and also having a slight lean towards commodities, because if inflation does spike back up, I think that's a key kind of risk that most people don't necessarily. It's like the hidden risk in many portfolios that we try to account for as portfolio managers.
It might be worth mentioning that, the way that we talk about sort of macro indicators and macro data and things like inflation on the podcast, if this is all you listen to with respect to kind of our investing style and portfolio management, it probably sounds like we turn over the portfolio 5 times a day. The reality is, we talk about this stuff because it's important and it doesn't move the overall market, but that's a very short-term phenomena. And the reality is, we talk about it, we think about it, but we rarely do anything about it because we like what we own, and we're not owning it for this week or this month. We're owning it for a much longer time horizon. And so a lot of this stuff is short-term noise.